Credit cards, magical plastic rectangles that let you buy stuff even when your bank account is dust bunnies. But how do they actually work? And why do some people swear by them while others treat them like financial poison? Today we're breaking down how credit cards really work, in plain English with zero judgment. A credit card works kind of like a short-term loan you can use over and over again. When you swipe or tap your credit card, you're not spending your money, you're spending the bank's money. Then, once a month, the bank sends you a bill saying, "Hey, remember all that stuff you bought? Time to pay up." If you pay the full amount on the bill, great. All you pay is what you actually spent with the credit card, without any additional cost. If you don't, well, that's where things get spicy. Every month you get a statement showing what you spent. That's your balance. It also shows a minimum payment, usually a fraction of your balance, like 2 to 3% of it. Paying only the minimum of it is like telling the bank, "Hey, charge me interest forever." Minimum payments keep your account in good standing, but they also keep you in debt for ages. Paying in full, that's how you win. Interest. That's the price you pay for borrowing the bank's money. Credit card interest is usually high compared to other kinds of loans, like 20% or more. But here's the key. You only pay interest if you don't pay your full balance by the due date. If you pay in full every month, the credit card costs you nothing. In fact, you may even earn rewards, which is like the credit card paying you. More on that later. Your credit card comes with a limit. That's the max you can borrow. How much of that limit you use is called credit utilization. Your credit utilization is a big factor that determines what your credit score is. Having too high of utilization, that is, using too much of your limit, can bring your credit score down, even if you pay on time. Most experts recommend keeping your balance under about 30% of your limit. Lower is always better. Credit cards often give you rewards. Typically, for every dollar you spend, you get a little bit of cash back, or points that can be saved up and exchanged for various benefits or perks. These are awesome and basically free, if you're paying in full. If you're paying interest, it's not such a great deal. The bank is basically saying, "Here's $5 in rewards, and also you owe us $40 in interest." Rewards are a bonus, not a reason to overspend. Credit cards are one of the easiest ways to build credit, if you use them wisely. They affect your score through a few factors. Payment history is the number one factor. Paying on time is everything. Utilization, again, how much of that credit limit you're actually using. Also, the length of your credit history. Having older accounts help, as long as they've been well managed. New credit. Too many applications in a given period of time can ding you. Use your card responsibly, and your score will thank you. Credit cards become dangerous when you spend more than you can pay back, carry a balance month after month, costing you interest, ignore statements and fail to pay on time, treat your credit limit like it's free money. But, used responsibly, they're one of the most powerful financial tools you can have. So that's how credit cards really work. They're short-term loans, interest if you carry a balance, rewards if you don't, and a big impact on your credit score. Used wisely, they're a superpower. Used recklessly, well, you get the idea. If this helped, hit like, drop a question in the comments, and tell me what money topic you want next.